Right. On behalf of the Community Foundation of Mississauga, I would like to offer all of you a warm welcome on this chilly afternoon. My name is Tom Cooney. I am the chair of the Endowment Committee at the Community Foundation of Mississauga. This committee was formed in order to assist the foundation in its community work by educating and attracting donors to its endowment. Joining me on the committee are Michael Giswaldi, Jim Kennedy, Lisa Sticht-Maximek, Susanna Winsborough, Kevin Wong, and the Foundation's president, Anne-Marie Pierce. Throughout the session, you probably will have a few questions. We will have a question and answer period towards the end, and I'll encourage you to take a few moments to type in your questions in the chat area at the bottom of your screen. We have designed a series that will provide essential information that you need to know as you assist your clients and they consider their financial, legal, and tax plans and how they can impact their community through philanthropy. Today's session is the first in our ongoing series aimed at our advisor community, and we will continue to provide valuable sessions related to charitable giving with technical and general content. This is also important information for those working in the charitable sector, and today we welcome guests who are advisors, individuals, and charities. I would now like to introduce Anne-Marie Pierce to provide remarks on behalf of the Community Foundation of Mississauga. Anne-Marie has been with the foundation for 4 years and is here to provide background on the Community Foundation and its endowment model and why donors are attracted to aligning their philanthropic goals with the Community Foundation. Please welcome Anne-Marie Pierce.
Thanks very much, Tom. I would like to also add my own warm welcome to all of you today. We are thrilled to be presenting the first in our ongoing charitable giving series, and we hope that will be of benefit to advisors, individuals, and charities alike. Our foundation was established 20 years ago as a grant-making community foundation, one of 192 across Canada. We join them with a commitment to doing good works in our individual communities. I wanted to take a few moments to talk about the Community Foundation's endowment model that is consistent across all community foundations for the benefit of our community for long-term, steady source of monies that are granted to charities each year. Charitable gifts are used to set up an endowment fund at the Community Foundation. The amounts required to establish a named fund are very accessible to any donor. As you'll hear today, a variety of funding sources can be used to establish a fund. The gift is held by the foundation forever in perpetuity, and the benefits to charity are unending. Donors like our model because they can work with us to establish a fund type that addresses their charitable vision with as much or as little hands-on involvement as they like. With a donor-advised fund, for instance, donors can work with us to advise the charities they wish to grant to each year. With a donor-designated fund, they can specify the charity of their choice to receive ongoing grants. What is true for all of these funds is that they are permanent, and so in perpetuity, they make an impact on charities. Our foundation is attractive to donors for a number of reasons. They can specify multiple charities as a recipient of their philanthropy. They can name the fund to honor someone special. Many choose the family fund name. It becomes a family focus where generations of family members can become involved in granting decisions. They can establish a fund during their lifetime, add to it at any time, and have the pleasure of knowing how the charities benefit from their giving. Many donors choose to establish a fund with a legacy bequest through their estate plans, knowing that their chosen charities are funded on an ongoing basis forever. Donors also have confidence in our endowment fund. We benefit from the professional management of Connor, Clark, and Lunn, along with experienced investment committee members that ensure that we maximize returns for long-term growth. As of last year, our endowment was $22 million. And finally, donors are pleased to know of the impact that they continue to make in our community. Because we grant across all sectors, we know our community extremely well. Our teams are experienced in assessing community needs and making effective grants both with and on behalf of donors. To date, our grants total $20 million, and charities across Mississauga and Peel have benefited. With our donors, we help to build a healthy, dynamic, successful community where everyone has an opportunity to thrive and no one is left behind. We hope that today you find inspiration in our first charitable giving series session. I know that you have the privilege of working with clients as they shape their future and their philanthropy. The Community Foundation has also had this honor, and we believe that charitable giving should be a joyful experience. If at any time you would like further information about charitable giving for your practice, we offer a host of resources on the Advisor tab on our website. And if we can help with specific information about whether our foundation is the right model for your clients, I'm happy to help. Enjoy your session. I'll now turn the session back over to Tom Cooney.
Thanks very much, Anne-Marie. We'll now begin the first segment of today's presentation, Gift Planning in Wills, presented by Susanna Winsborough and Lisa Sticht-Maximek. Susanna is a partner at Kaiser Mason Ball, LLP, a member of the firm's corporate commercial group, and leads the firm's business and estate succession group. She has a practice that focuses on succession for both individuals and corporations, and advises and assists clients with their personal estate planning needs, family business succession plans, and corporate reorganization plans. Susanna has vast experience in complex estate planning, including multiple will strategies, Henson trusts, and various other testamentary trusts. She also prepares and advises on different types of inter vivos trusts, including joint partner trusts and discretionary family trusts, typically as part of a greater tax plan. Susanna regularly works with clients, accountants, and other professional advisors to implement business succession plans that will give effect to the interests and wishes of clients while simultaneously protecting the business and the client's beneficiaries and successors. Lisa Sticht-Maximek's practice encompasses all aspects of estate planning, estate administration, power of attorney guardianship administration, estate litigation, and applications for guardianship for incapable adults. Lisa provides clients with broad estate planning advice and prepares comprehensive wills, testamentary trusts of all kinds, powers of attorney for property, powers of attorney for personal care, living wills, wills agreements, and related documents needed to implement comprehensive estate plans, which are tailored to each client's unique needs. Please welcome Susanna and Lisa.
Thank you so much, Tom. Good afternoon, everyone. Lisa and I are happy to have this opportunity to take you through the who, what, when, where, why, and how of charitable giving. Before we jump into the presentation, we just need to mention that the information provided in today's presentation is intended as legal information only and not as legal advice. But if you would like legal advice, you can reach out to either one of us at the numbers or email addresses provided on this slide. If you could skip to the next slide, perfect. So for our presentation, Lisa and I will be reviewing charitable giving in the context of estate planning through the topics set out here. Why is a client interested in making a charitable gift? When will the charitable gift be made? Where should charitable intentions be recorded? How should the gift be structured? Who is the intended recipient? And what can be donated? Next slide, please. Oh, nope, that's perfect. So the first question we need to ask when we're meeting with a client who raises the idea of giving to charity is why? Why is the client interested in making a charitable gift? The motivation behind the gift is going to drive not only the type of organization that should receive the gift, but also the timing of the gift. Is the gift being made for a philanthropic reason? Is there a need in the community they wish to fill? Have they had an illness or lost a family member to an illness and want to support research? Does giving back to the community just make them feel good? Do they want to be able to see the good their gift is doing? Or is it just for tax planning? If the gift is for tax reasons, it's not enough to donate to any not-for-profit organization. The organization receiving the gift needs to have charitable status. If the purpose is philanthropic, but the donor wants to see the impact of their gift, then of course the gift would need to be made during their lifetime.
So in terms of timing, Timing is very important because we need to help our clients sometimes plan for when they're trying to create their gift. So it's really essential that our clients give some thought and that the advisors are probing when it is that the clients want their charitable intentions to be realized. Are they looking at making a donation during lifetime, or is it a donation to come into effect after death? Or perhaps it's a combination of both. Either way, sometimes we need to do some advanced planning, whether it's financial planning, whether it's tax planning or estate planning. Certainly a one-time gift is one that doesn't require much in the way of planning. But if we've got clients that are looking to make monthly or annual contributions, then sometimes we need to look at the financial plan and make sure that they have sufficient funds, liquidity becoming available on a regular basis in order to make those gifts. If clients are looking to make a lasting legacy, like a gift to a foundation, for example, whether it's a small or a larger amount, that's going to require a little bit more planning. And so we'll want to direct them into the right resources. Planning after death, timing is also very important because we need to understand when after death does the client intend the gift to take effect. Are they looking at the charitable gift to become effective immediately after they die, before other beneficiaries, ahead of a spouse perhaps, or ahead of the children? Maybe their charitable intention is that it's a gift that's shared with other beneficiaries and paid at the same time. Alternatively, it might be a contingent gift. We often see clients who say, well, I want to leave a house or a certain cash amount to a specific individual. Perhaps it's held in a trust for that individual. But if that individual dies before me, or if they've died and there's still something left in the trust that hasn't been distributed out, that might be the point at which they want the proceeds to go to charity. So that would be a contingent gift. And also commonly, clients are looking at making perhaps their larger charitable contribution at a point in time after death when there's no one left that they wish to inherit their assets. So in the common family disaster situation, if they have no spouse, no children, or other family members that they want to include, that might be the point in time when they're looking to include charity in their gift giving. So once we've established timing, the where is really important. Where do we record these intentions? It's really not enough to just have a desire to make a gift. It's important that that intention is recorded in writing. Certainly not if we're making a gift immediately, but if we're looking at gifts to be made in the future and we want them to be binding, these intentions need to be put into writing. So consider for a moment a situation where you have a client who may be interested in making an ongoing gift, an annual gift to charity. If that person has well enough property and they don't really need to worry too much about preserving property for the remainder of their life, they want to see that that gift continues to be made on an annual basis, even after they might have become incapacitated. For example, onset of dementia or Alzheimer's. It would be really important that those intentions are recorded in a power of attorney for property. Otherwise, the power of attorney may have limits on the ability to make those donations. This is a bit of a technical point, so I won't belabor it, but there is legislation under the Substitute Decisions Act that does provide some guidance to attorneys when they're wanting to make charitable gifts. But the overriding message here is that if you want to make the job for your attorney easier and you want to make sure that gifts are being carried out when you're incapacitated, it should be set out very clearly in your power of attorney for property. More commonly, we would see an intention for making a charitable gift after death. Well, again, you know, a phone call to someone to say, hey, when you get this inheritance from me, I want to make sure you donate some of it to charity. That isn't binding. That's just a wish. If you make a gift is a gift and there's no strings attached. So the person who receives it should be free to do with it as they choose. So if you do wish charity to be included, then it's really essential that that wish be put in writing, especially if you want it to be binding on your executors. For proceeds of RSPs or RIFs, or even life insurance proceeds, these sorts of gifts can be made directly in writing on beneficiary designation forms, specifically with the financial institutions or the life insurance company, Alternatively, if we're looking for more creative planning, those designations might be contained within the will. But certainly for any other gifting that's to happen after death, if you want it binding on your executor, it needs to be in the will. And we have to remember that wills are formal documents, and so certain formalities have to be observed in order for those wishes to be carried out and binding.
So once we've determined that the gift should appear in the will, the next step is to consider how the gift should be structured. And there are a few ways to do this. One way is to simply specify a fixed amount of money outright to a charitable organization. For instance, you can say $10,000 to a particular charity. When leaving a fixed amount, though, you need to consider a couple things. One is how much that $10,000 will actually be worth at the time of your death, due to inflation, for example. And another is that if all that you have left in your estate after your debts and taxes are paid is this $10,000, the beneficiaries who were to share in the remainder of your estate will get nothing because there's nothing left to share. So, for example, if your will says $10,000 to a particular charity and the balance of the estate goes to your children, in this case, the charity will get $10,000 and your children will get nothing, presuming that they're not dependents and they have no other recourse. Another way to structure the gift is through a percentage of the balance of the estate, which is also known as the residue of the estate. This percentage could be the entire residue of the estate, or as Lisa mentioned earlier, can be shared with other beneficiaries. But because it's rather difficult to predict how much money is going to be left in your estate after you die, the charitable organization may end up getting more money, it's not a bad thing, or less money than you intended. So that's something you need to keep in mind when structuring it this way. If you know you want to give back to the community or take advantage of tax credits, but you don't have a specific cause in mind, then contributing a fixed amount or a percentage of your estate to a foundation like the Community Foundation of Mississauga is a great way to structure the gift. The Community Foundation of Mississauga, for instance, is aware of the needs within our community and can direct the funds accordingly. And in addition, the Community Foundation of Mississauga can also provide a tax receipt. How much you leave to the charity is another important consideration. For instance, you need to think about what you can afford. Are there dependents that you need to be taking care of first, children or a spouse? Will you still need it? If gifting during your life, will there be enough money left in your assets to take care of you first? Will the gift still be available when you die? If you're gifting a specific account or asset, then will that account or asset still exist at the time of your death? And what are the tax benefits? Different assets may have other benefits besides the tax credit that should be considered. So you should definitely speak to your advisor if the purpose of your gift is tax driven. When naming the charitable organization in your will, it's important to use the correct legal name to avoid any confusion and make it easier for your executors. We generally include the charity registration number in wills to help identify the organization. If the gift is intended to be used for general purposes, then naming the charity is enough. For instance, you can leave a sum of money to a local hospital. But if you want the gift to be used for a specific purpose, then the purpose needs to be set out. For example, you can leave a sum of money to a local hospital, but it can be earmarked for the pediatric ward. Along the same lines, you can leave a sum of money to the Community Foundation for general purposes, or depending on the type of fund established, you can also direct which charities are to benefit from the fund. If you've already set up a fund with the Community Foundation, then the name of the fund should be included in your will to make sure that the money is directed to that particular fund.
So a lot of clients, when we talk about making donations, maybe haven't really given much thought about what they'd like to donate beyond the more obvious cash donations. We all understand that cash is easily donated, and I think probably many charities might prefer cash, but there are lots of other ways that we can donate. We can donate services if those services have value. We can donate, as we mentioned before, life insurance proceeds, RSPs, art, and other valuable property. Some people don't realize that those can be donated. We can donate shares, securities, or other capital, and real estate also can be donated. I know that Kevin's going to be speaking shortly about some of the tax implications of various items that can be donated, but sometimes on the planning side, on the estate side, we also want to think about the purpose of the donation and whether the charity is going to be in a position to accept the gift. For example, if all of a sudden someone's realizing, oh, real estate, that sounds attractive, maybe I'd like to donate real estate. Well, that may be fine, although you may have very specific purpose behind that gift, and you might want the real estate to be used for only certain things. So you'd have to really have a conversation with the charity and really be clear about what kind of conditions you're placing on that gift, because it might be that the charity, as much as it would like to receive the gift, might have to decline the gift if it realizes that it can't carry out those terms. Or you'd want to make sure, for example, that the charity has the ability to sell the real estate if it can't maintain the property over time. Sometimes people don't realize that certain assets require management. They need to be insured and managed. And if the charity can't do that anymore, what's to happen to the property at that time? Often clients may not have even considered endowment funds, and those are the gifts that we're talking about today, the gift given into perpetuity, the gift that goes on forever. So certainly I think it's our responsibility to provide information to our clients. Once we understand all the questions that we've asked, it's our job to direct the clients to the right resources, and certainly we can direct them to the Community Foundation of Mississauga or other local foundations for more information on how to best structure their gift. So I think I'll leave that with our comments with respect to the will planning side of charitable giving, and we'll let Kevin take over on the interesting information about tax considerations.
Great, thank you very much, Lisa and Susanna. Wonderful information about wills and how individuals can incorporate charitable giving in their plans. Now moving to our second segment. This segment is called Tax Considerations, presented by Kevin Wong, partner at MDP LLP. Kevin obtained his Master of Tax degree from the University of Waterloo in 2004. Since then, Kevin has worked closely with clients in a wide range of tax areas, including tax planning for medical professionals and senior executives of large corporations, corporate reorganizations, cross-border tax planning, as well as regular compliance issues. Please welcome Kevin Wong.
Thank you very much. So just a disclaimer, I've set a timer for myself because I tend to talk a lot. So if you hear a beep in between, it's not a fire alarm, it's just my alarm. Okay, so today I'm asked to talk about the tax consideration, and specifically I'll be dealing with the why, the what, and the when. So as Susanna and Lisa has talked about the why already, obviously there's a general good to the community for making a donation. Next slide, please. Honestly speaking, when the file gets to my desk, that stage has long passed already. So the clients will be more interesting to hear from me regarding the tax benefit. And therefore, on the next slide, I'm going to explain the tax benefit a little bit. The tax system in Canada is interesting in a sense that there is the federal filing and there is a provincial filing as well. When the donation is being made by an individual, on the federal side, the donation tax credit is 15% on the initial $200 of donation, and then thereafter is 29%. A few years ago, there was a super tax credit got introduced. In order to offset the tax on that super tax credit, there is a third donation tax credit got introduced. And the donation tax credit is 33% if the income of the individual exceeds $210,000 approximately. On the Ontario side, the tax credit is 5.05% on the initial $200 of donation, and then 11.16% thereafter. What you may be thinking is that, well, Kevin, I heard that you are good, and how come you're giving me this income tax definition? And therefore, in the next slide, I try to be more explicit. So for some individuals who are better in math, what I would say is that, well, the donation tax credit, for every $1 of donation, the tax credit can be anywhere from approximately 20% to 50%. Now, if you're with me and you're good with math, you may notice that on the previous slide, I mentioned that the maximum federal tax credit is 33%, and the max Ontario credit is 11%. 33 plus 11, that's 44, that's not 50. Then how did the 50% come about? The reason is that in Ontario, we have an interesting surtax system, which is a tax on tax. So once we have claimed a donation tax credit, and when we take the reduction in the surtax into account, the maximum donation tax credit is indeed over 50%. To clients, I would likely not say that, but instead I would say the next line instead. So in plain English, the favorite charity will get $1, which will only cost the donor 50 cents. And what I would normally say on that as well is that, well, remember those matching programs that we sometimes hear from the big corporation, and when they run any fundraising for the hospital, that if you donate $1, that some other organization would match your donation. And guess what? That matching program is always there, which is sponsored by the federal government. The donation credit indeed is a very powerful way to reduce one's tax liability. Moving on to talk about what to donate. So as Lisa mentioned earlier already, well, cash is the one that we always think of. Write a check to the local charity or the foundation, that's easy. Or, oh, buy chocolate when the charity comes for their door-to-door sale, even though it has been a long while since I've not last seen them and I miss them. Besides cash, there are also possibility to donate other property. Those are the in-kind donation, which I'll talk more in the coming up slides. And then there's also the interesting discussion when we want to donate, like life insurance proceeds or residue in properties. So if we do want to go with an in-kind donation, what is the tax result? It's really no secret. For tax purposes, when we want to donate in-kind, really two things has happened. Step one, I am considered to have sold that particular property in the open market for cash, and then I donate the cash to the local charity. And since there is a deemed disposition of assets, any gain that I have on this particular property would be considered an income that I need to pay tax on. And on this slide, I mentioned that the gain can either be considered a capital gain or an income. The example I can come up with is that, let's say that I want to donate a vehicle, a car. If I donate a car myself, well, I mean, I have used the car for a number of years already and I want to donate. Eventually, assume for a moment, I realize a gain on the vehicle. When I donate my personal vehicle, that would be considered a capital gain. However, if I'm a car dealership, the car really is part of my inventory. In that situation, if I donate a car to the foundation or a charity, that would be considered a business income. And I know in the general public, we always think that, okay, if I donate something, there's a gain, that is a capital gain. Usually that is the case, but not necessarily. There is an exemption though. If I donate the, in quote, right type of property, I may be able to avoid the tax. So on this slide, I mentioned the three specific properties. The first one being some publicly traded securities, ecologically sensitive land, or cultural property. I'm going to talk more about them in the next slide, but there are two more comments on this particular page. If I want to be able to take advantage of this tax exemption, the donee must be a charity. It cannot be a private foundation. And if the donor is the estate, the donor must be considered a GRE, a graduated rate estate. So before I talk about this slide, there's actually one more point I want to mention. Back a few years ago, I believe the year was in 2017, or it could be in 2018, there was a proposal to expand the tax-free category to also donation of real estate and private corporation shares. Unfortunately, that plan did not get carried out, so that is not part of the current law. And given the current situation, I do not believe that we will see that law being enacted in the near future. Okay, so let's go back and talk about, on this particular slide, what are the things that we need to be careful of? If I want to donate any eco-sensitive land or cultural property, someone needs to certify that, and there's a process for doing so. And in my office, we have seen that a couple of times already. In the year of donation, it's almost impossible to get the certificate on time. It could be years later before we see the certificate, if ever at all. I see that Lisa is shaking her head already. So it's going to take a very, very long time. We just need to be mindful of the timing that, well, if someone is on top of that, and it will never be forgotten. On the valuation issue, if I want to donate other types of property, for example, artwork or wine, what exactly is the value of those property? Artwork may be slightly easier. We go hire a qualifying appraiser, give us a value of the opinion, and that could be the basis of that already. Wine is one of the things that get donated all the time, but that would create some problem. And I do want to mention a court cases that was in 2018. So when an individual donated some wine from his own collection, probably some really good wine, there's no formal appraisal of those wine, obviously, because it's really in his collection. And therefore, he did the right thing already. He go find an appraiser, appraise the wine being at $21,000, and use that amount on the tax return. Serious disagree, and that case went all the way to the tax court. At the end, the tax court rejected the position. Specifically, what the client, what the individual and the appraiser did is that they went to the LCBO, specifically the private ordering system, to look up the price and say that, wow, in the LCBO, if I want to order the same wine, the cost is X, and therefore we think that is the value. The court rejected that because the court did say that, well, the LCBO is a very controlled market. There's no way that anyone can sell those wine in an open market, being in an auction situation for the same price. And therefore, the court decided to use an auction price being only $5,000. I do not take that as a bad news. One thing we need to be mindful is that in this particular case, the donation, the collection of wine is really in the donor's collection. If someone wants to go to the LCBO to purchase a bottle, an expensive one, and donate, I do believe that the purchase price would be considered the donation value. And the other problem with this particular case is that those wines are so specific that are just not available in the LCBO at all. And they have to go through the LCBO private ordering program. On the other hand, if this wine is actually readily available on the LCBO shelf, that may come up with a different result. So that's my comment on the wine. On the residual interest in property, there was also a very interesting court case on that. So in that particular court case, this wealthy individual owned a piece of property in the country. He really likes his house, obviously. And he, to a point that he likes the view so much, he purchased the next parcel of land as well. He wants to make sure that nothing will ever be built on that other parcel that would block his view. But he knows that he doesn't really need that other parcel, and therefore he would like to donate that to a charity. However, when he wants to structure the affair, there is a very big constraint on that, saying that, well, charity, once you get this parcel of land, you are not allowed to do anything with it because I want to protect my field. And therefore, the question is whether that really was a donation made at that point, or is that at a later point when the individual eventually passed away. And the decision is there was not an immediate donation. Really, the gift is deemed to be made years after when he eventually passes. Okay, so on the next slide, there are some quick points on the donation of life insurance. Next slide, please. Thank you. And I'm sure when you go to a different seminar, you will have got this information already, but I do think it's fair to quickly mention that. When we donate life insurance, there are different ways to structure that. The first way is that we can donate the death benefit through will. What does that mean specifically? I go to Sun Life, I go to Manulife, purchase a life insurance policy. The beneficiary will be my estate. And then in my will, I will say that, well, through my life insurance, I will receive a death benefit. I would like my executor to donate that to the charity. That is perfectly fine. That will be considered a donation when I pass this, not the current donation. And because the death benefit will be paid to my estate, there is a requirement to pay a probate fee on that death benefit. To make it better, I can change the life insurance policy in a sense that I can change the beneficiary from my estate to the charity directly. It will still not be considered a current donation. However, since the death benefit will not be passing through my estate, I may not need to pay probate fee on that. There is a way to structure a life insurance donation currently, which is actually changing the owner and the beneficiary right now to the charity. For example, let's say the death benefit is $1 million, and I want to do this strategy right now. It will be considered a current donation, but it will not be of the full $1 million because that $1 million death benefit will only be paid at a future point in time. Instead, my current donation will be limited to the current value of the life insurance policy. And that requires a need to do a valuation as to what is the current value, the true value of the life insurance policy. And I guess that will be dependent on my health condition and on the replacement costs. If we do want to carry out with this strategy, there needs to be a discussion with the charity or the foundation to see how it should be carried out, because once this donation is made, the charity will then have the ongoing obligation to pay the annual premium. The foundation and charity may or may not want to do that. And therefore, there may be a need for the donor to commit to a further donation, either a one-time lump sum to satisfy the future premium payment, or an annual donation to satisfy the annual donation payment. Okay, so on the next slide, I'm going to talk about the when. When is the appropriate time to structure this gift? If we do want to do a testamentary gift, meaning that I will not make a current donation, instead I will enter into my will saying that well, X dollar amount or Y percentage will be donated. The tax will actually change over the last several years, and I believe the change was in year 2015 or 2016. Under the historical rule, if some conditions are met, the testamentary gift will be deemed to be made by the deceased just prior to death. Under the old rule, if the gift will be made by a GRE, a graduated rate estate, the donation can now be claimed on a number of different filings. There will not be a deeming provision per se anymore, but instead the executor at that time can go through all the filing and see what is the most beneficial ways to claim the donation. And specifically, the choices are as follows. The donation can be claimed on the terminal personal tax return of the individual, being the T1 return, or sometimes we call it the T1D return. We can also claim this donation on the T1 of the year immediately preceding death. Let's say that we do not want to do either one of the two. What I can do is that I can claim the donation in the estate trust return in the year the gift is made. Or I can also claim it in any preceding year of the GRE's T3 estate trust return. And let's say that, well, for whatever reason, we still cannot use up the donation. There is a 5 years carry forward. Before we go to the next slide, specifically my comment is, this rule is only applicable if the donation is being made by a graduated rate estate. Let's say for any reason, the estate cannot be considered a GRE, what would happen? On the next slide, if the donation is not made by a GRE, then my choice will be very limited. From 5 choices, I'm down to 3 now. If it's not made by a GRE, I can only claim the gift in the T3 return in the year of gift. And if I cannot use the donation, there will be a 5 years carry forward, but that is it already. Okay, so the main reason as to why we want to consider a testamentary gift. The donor probably do want to retain most of the assets during one's lifetime due to any expected or, more importantly, unexpected cash need. The donor will be more comfortable to only make the gift when he or she is gone. There is the main reason as to why we may not want to do that. As Lisa mentioned earlier, sometimes the eventual gift is so large that we may not be able to use up the entire donation tax credit. That could be the claim, that could be the case if the individual will be showing very low income in all the applicable tax return. Or maybe the accrued gain on the assets is so little, there's just not enough room to absorb all the donation tax credit. And more importantly, in case of a family disaster, maybe the entire estate is being donated. In this case, it's almost for sure that the individual may not be able to use up the donation tax credit. And therefore, sometimes we will then talk about, okay, what if we want to make a lifetime gift? So on the next slide, those are the information regarding an inter vivo gifts. If one wants to make a donation in the current year, the donation can be claimed, well, obviously, in the year of gifting on the T1 personal income tax return. And there is a 5 years carry forward period. So the main why as to why we want to consider making inter vivo gifts. The main reason is really to spread out the donation tax credit to make sure those credit can be used more effectively and more currently. A tax saving right now is definitely better than a tax saving 20 years later. But the main why not as to why I want to stay away from that, that's really due to the uncertainty. What if I have increased cash need during my retirement life, my housing needs, my medical needs? Those are all the questions that we should be thinking. And in my practice, what I would typically do is to really do two calculations. What if the individual passed away tomorrow? How would the tax return look like? And then try to put in the donation piece as to whether we will be able to use the donation tax credit effectively. And then the next calculation will be a projection. We know that you're in good, healthy shape. Realistically, let's do a planning for the next 20 years. How would the tax return look like? And then we can then make a decision accordingly. And that's pretty much all I want to express today. But two more comments before I pass my time back to Tom. The tax row is tricky in the sense that there are lots of little tricks here. So the purpose of today is to give a general overview of the tax consideration. There are ways to make it better, but at the same time, if we're not careful, there are also all the traps that we can easily fall into. And when I talk to a client, and I will always talk about this piece. When we do a planning right, what are we trying to achieve here? If there's no planning at all, the estate will be going to who? The loved one and the government. If we do the proper planning, what we may be able to achieve is not to reduce the distribution to the loved one, but to redirect the fund from taxes to CRA to your favorite charity. So what we are really doing is to converting a public donation to a private one. And I do see that that being beneficial to everyone. Thank you.
Great, thanks, Kevin. That was wonderful. Lots of good information from your session today. I really learned a lot. And as we get into the Q&A period now, I wanted to let everyone know, because someone was kind enough to ask this question, and that is, will this session be available to us afterwards? Because it's pretty difficult to take copious notes and have them have meaning. It's nice to see the same session again to remind us, or go through a perhaps more difficult area that we'd like to see one more time. Yes, it will be available, and we'll let you know about that. We'll make sure that you are informed about when it's available. The first question, I'm going to actually throw it out to Anne Marie. A question came about the starting point of today, and that's endowments. Could you help us, Anne Marie, understand a little bit better what is an endowment? Perhaps you could give us an example.
Sure. At its very core, an endowment fund is a fund literally held, donated to an organization, a charity such as ours, and held forever. So the principal of the principal amount, so the amount donated, is held in our fund. It is invested in our pooled fund, and the investment income is used to grant to charities. And so that's really at the core of an endowment. So it's a donation, creating a fund that a donor creates, and how they name it is really a joy to see. And then the investment income is how we impact charities. So we are very thoughtful about how we make endowment giving accessible to everyone. So we have various levels of giving. So for instance, in our Mississauga fund, it's an unrestricted fund. So anyone who creates a named fund, a family name or whatever name they choose to name it, those funds will be pooled under the Mississauga Fund, and those monies will be granted to charities across Mississauga, making an impact on on a variety of types of charities. Donor designated funds are a little bit different, and that's where the donor has the ability to create a fund where they have a target for their philanthropy. They know very well where they would like to make an impact, and so they create a donor designated fund. They may designate one or a number of charities to receive the monies annually that are created through the investment income. We also have field of interest funds where we have several headings that we sort of have a collective of donors who have created environment funds. They've created smart and caring children and youth funds, and they've created arts funds. And so, we have field of interest funds so that people can really make an impact on a type of charity. And finally, donor advised funds. People may have heard a lot about donor advised funds. We work with donors who wish to create a fund where they want to have a say. They would like to make an impact on charity each and every year. And so our team knows charities very well across Mississauga. We're very experienced at making impactful grants. And so we're able to provide our donors with support and with information about what that would look like as they select charities for which they'd like to make an impact. And so, for instance, we will chat, and they may ask us to do some research, and we will do that. Others come to us each and every year, fully knowledgeable about what charities they'd like to use to make an impact. So those are the types of funds, and how a fund is created. I wanted to just also speak to this because we also have charities who have endowment funds with us, and so those funds are set aside. Those were created by charities so that they would have a nexus for some of their donors to make perhaps a planned gift, a gift through their estate, or a present gift, but to help that charity have a long-term steady source of income. So that's just a little thumbnail sketch about our endowments.
Great, thanks very much, Anne Marie. This next one, I believe, is for Lisa and Susanna. Are you finding a trend where clients are bringing up charitable giving or bequests when they arrive at your office to start talking about their estate plan, or are you finding it's more you guys generating or initiating that conversation?
Susanna, maybe I'll jump in first.
Sure.
Just in terms of my own experience, I see both actually, even for the estate planning. I mean, sometimes I'm the first person, someone says, I need a will, they're looking for their lawyer. And then once we have the conversation, we might identify all kinds of needs, including their philanthropic wishes. Then we might direct them to an accountant. If they don't have one, we may direct them to a financial advisor or to the foundation directly or something. Other times, though, clients are coming to us from those places because that conversation started there. So in my experience, it's really a mix of all of them. Susanna, how about you?
And I would say I've had a similar experience. I'd say more so when clients are coming and they have significant assets, there is a concern about giving everything to their children. And so in that case, they'll give maybe a legacy, a fixed amount to their children, or a smaller percentage of the estate to their children. And then name a charity or a foundation as the beneficiary to receive the bulk of the estate. So that typically comes up. It's prompted by the client in that case, but I'm also finding that a lot of people, they come in and the idea is everything to the spouse and then everything to the kids, and that's really all they have in mind. And that is often when we will bring up a situation where, well, what if there's a family disaster? What do you want to happen in that event? And they haven't turned their attention to it. And then we have the opportunity to say, well, hey, here's a good time. Your spouse doesn't need it. Your kids don't need it. How about charity? And so I'm finding that's the typical way.
And if they go down that road and they're starting to prepare, looking at some charitable bequests, do you find in some cases or most cases that they want the next generation or perhaps 2 generations to be involved in the overall planning?
That's hard to say. Some clients like to have a lot of control and they like to keep that control even well beyond the grave. So sometimes we have to rein them in a little bit. It depends, when I'm dealing with some of the higher net worth families, they might even be doing some of this planning together. And so sometimes they're looking at, finding this one base, and then all of them are going to make contributions at various times. Certain family members can make, it's usually the parents who can make the greater contribution earlier with the intention that the children might participate down the road. So they're certainly endowed funds are really the direction of what they're looking for. Yeah,
I'd agree. And I'd say that if it was a situation where a client did want to get next generations involved, then that might be a situation where I say, you know what, maybe you should consider setting up the fund now and not just doing it through your will. Set something up now and get your children, grandchildren, whomever involved now so that they understand the purpose and they're just used to it. It becomes a part of their life.
Thank you.
If I can add, Tom, we've
Sure.
actually seen that in practice here at the foundation. So we have a number of donors who have set up a fund in their lifetime, as well as a bequest, through their estate plans. But they, it's so important. So important is charity to them and doing good works, that they want to make sure that is, really that the next generation embraces that. And gosh, it's such an incredibly, inspiring sight when you see that next generation, kind of coming together with, the parents. And in some cases, there's an intergenerational of 3 generations at the table, making suggestions and having discussions. So I just wanted to follow up with Susanna and Lisa that it actually, we see it on our end as well. And so it's really quite inspiring.
Great, thank you. Kevin, I was a little disappointed to hear that wine collections are problematic, although I guess on the positive side, that means we should take care of them while we're alive and make sure that there's little stock left at that point. Graduated rate estates, could you define that for me?
Yeah, absolutely. So that's a new concept got introduced since 2016. So when someone passed away, all the assets, well, as long as it's governed by will be passed to an estate. So a graduated estate is specifically defined as the only estate of the individual that is in existence due to a will. And a graduated estate would enjoy the low tax rate, or specifically the graduated tax rate for the initial 36 months. And it's important to draw a distinction between an estate and the trust, because sometimes what I may say is that, well, in my will, I want the executor to hold on this particular portion of assets for my minor child until he or she turns age 18. In the past, the taxation is the same, and therefore we don't really care all that much. But on a going forward basis, actually since 2016, we need to be sure is that are we dealing with the estate that it was established after someone died, or are we now looking at the trust that is holding an asset for someone because of a term in the will?
Got it. Thank you. On the estate planning side, how often should estate plans be reviewed?
So we recommend every 3 to 5 years, take a look at the plan and take a look at your will, see if it still makes sense. And then anytime there is a major event. So if an executor dies, then you should be taking a look at your will to make sure you have the necessary backups. If a beneficiary dies and there hasn't been a contingency put in place, then certainly that's a time that you would need to be changing your will and taking a look to see if you do have that contingency in place. Do you have anything to add, Lisa?
I might even say just other major life events. You know, if there's some major change in the family, sometimes a marriage of children might impact having grandkids that might not otherwise have been included in the will. Those are big times. Or if there's any major change in even financial status, those would be times, I think, to review also.
Great.
And also, if you do end up getting married and you had a will beforehand, that will is now void. So if you get married, definitely be taking a look at getting your will updated or redone.
Perfect. Sorry, go ahead.
On that note, I think accounting is being slightly easier because we see clients' financial every single year. So we look at the corporate financial, we look at the personal tax return. So I do agree when there's a major change in event, that's the time when the estate plan should be visited. But in all fairness, I think the accountant really should be more mindful of this. And when they look at the financial statements or a tax return, they do think about, okay, whether there's any changes that could impact the overall estate plan.
Kevin, I imagine in your practice, you would also see clients, or some of your associates would see clients when they're gifting monies each year to charities on a regular basis, whether that's all in cash or by appreciated securities, and there'd be an opportunity there to chat with them about changing course if they were only doing cash every single year.
Yeah, absolutely. So even though as advisor, we could be familiar with the rule, but it may not be so obvious to some clients. So actually just last month, a client of mine asked me the same question. He wants to make a big donation because he had a good year. And he's thinking whether it should be from his personal bank account, from his OpCo, HoldCo, or from whatever entity. But I'm saying, wait a second here. I remember in your portfolio, you do have some investment that shows a significant accrued gain. Why don't you just donate 1 or 2 shares in Apple or Shopify? That would achieve your goal, but at the same time, you will achieve all the benefit as well. So I do think that when someone gives an advice, it needs to look at on a global basis as to, okay, is there any better way to structure the same gift?
Perfect. Well, thank you all. I guess we're coming up to the close of the hour now. So I would like to once again thank our presenters, Susanna, Lisa, and Kevin, for sharing your expertise with us today. This is valuable information for our advisors, charities, and individuals alike. Now, as a follow-up to today's session, we will send you a brief survey for your feedback and suggestions on future sessions. I'm happy to report that our next session will be scheduled very soon, and it's called Having the Philanthropic Conversation. So stay tuned for registration details that will get out to you. As well, if you feel that your firm would benefit from an information session, please contact Anne-Marie Pierce and we'll be happy to arrange this for you. The Community Foundation of Mississauga works tirelessly to encourage philanthropy in support of our community. We hope you will join us in shining a light on our work when appropriate, bring the foundation into the discussion. Anne-Marie Pierce is happy to provide with information you may require. We also point you out to our website under the Advisor tab. There's some excellent supporting resources and information there. Finally, on behalf of the Endowment Committee, thank you for attending today's session. We are very pleased that you could join us. Enjoy the rest of your day.